Connecticut man has been warning the public, get your money out of U.S. banks immediately. A historic financial reset in 2023 could cause a run on the banks unlike anything in our nation's history, he says. His warning has already reached 8.4 million Americans and 30 TV networks. And yet, few people realize this could actually happen on U.S. soil, or what a sizable impact it could have on your wealth, especially if you have large amounts of cash in the bank right now. Normally, I might ignore all this, but it turns out he's a Wall Street legend whose work predicted the COVID crash, the 2022 crash, and the 20 best stocks of 2022, and more. Today, he's urging you to move your money into a new vehicle 50 years in the making. He's even posting a free recommendation, which you can access at reset2023.com. His work pointed to a 10,090% gain back in 2020, so don't miss this. A new vehicle outside the banking system could massively boost your wealth. You can get the details today at reset2023.com. Again, that's reset2023.com. Hi, this is Daniela Cambone. Welcome back to the Daniela Cambone Show. Joined today in studio with Will Rhind, CEO and founder of GraniteShares ETF. Always good to be. It's been too long, first and foremost. So nice to see you in person, Will. Welcome to the studio.
Yeah, thank you so much. Great to be here in person as well.
Yes, yes, and no shortage of news here. Lots of things I want to get your insights on. Obviously, talk commodities super cycle, and all that. But first, let's talk the Fed. We see the latest inflation data showing that it's cooling off. Your take on what the Fed might do next year, given the recent data?
Well, I think it's only one print, so clearly,
Right.
it's not a trend, so to
Right.
speak, as yet. I think as far as the Fed's concerned, but I do think it probably gives them some license to start easing off now. So, for example, rate hike odds for December being 75 basis points. I think that's significantly reduced now because of this number. So, I think that if this is the start of the trend, which I think it very well could be, I think we see lower interest rates from here.
Same thing over in Europe as well. Someone at the ECB signaling that they've hit peak inflation. So a trend that perhaps can ripple here, Will?
I think so. I mean, clearly that's what everybody was waiting to see.
Right.
And I guess hoping, certainly if you're a consumer, hoping for that trend to roll over. We've certainly seen it if you look at the numbers. These anomalies like used cars, used car sales, used cars falling 2.4%, month over month. Housing, we've seen, housing is already in a recession here in the United States. Housing has rolled over first. The direct effects from the Fed tightening, from mortgage rates going up, from just general financial conditions tightening, makes it much harder to get financing if you're looking to buy a car, if you're looking to buy a home, or even we saw apparel come down with the buy now, pay later type schemes.
Let's just play it out, because I feel, for the longest time we've lived in QE and tightening. It's like we don't know a world outside of those two realms. What would the Fed do next? What happens after this? Where does the focus go?
Well, I think the focus is going to be still on reducing interest rates. I think the key is going to be still on reducing inflation and bringing that inflation back to target. I think the interesting point is really what inflation number are they really focused on? Because we've got headline inflation,
That's right.
We've got core inflation, we've got a number of different numbers that ranging from sort of 7-8% down to 6% and lower if you're looking at service inflation. So what number are they really focused on to bring that back down to trend? Because 2% clearly is a big way to go.
Right, exactly, and that's a really good point, because behind the scenes, or on the flip side, I should say rather, you have all these massive layoffs taking place. We saw what happened at Meta, Facebook parent company. So you have the massive layoffs, but they're telling us, hold on, inflation's coming down. What should I be reading between the lines here?
I think that the Fed. And it's just a classic. They can only look in the rearview mirror.
Right.
So a lot of this data lags, as we know, and so it takes some time before those effects filter into the economy. We start to see it really visibly. Take hiring, for example. The announcements that we see, that's just the tip of the iceberg, because as we know, the majority of certainly corporate hiring and or firing decisions come at the end of the year. And these are obviously very well staged, managed through review processes and things like that. Then even once people get fired, once the announcement's made, it might not show up for another few months once, notice periods and things like that are accounted for. So there's a lot of lag in this that needs to be factored in.
So we're in the last quarter of the year here. Usually, as we know, the Santa Claus rally happens. Do you see that in the cards or the opposite here? What do you see for stocks?
I think that there definitely could be a rally, and it's probably more likely to be a rally than not, just because of what's happened this year. But the rally is going to be largely technical based as opposed to fundamental. We've still got huge amount of problems in the economy, and I think the economy, it gets worse from here, not better. But certainly, because of what we've seen this year and the amount of pressure on the market, I think from a technical perspective, we could be set up for an end-of-year rally.
So how much to the upside could you see?
I don't think crazy amounts from here. I think probably low 4,000s for the S&P, something like that is possible. But certainly, I don't think too much more than that.
Just another point before we talk commodities, we saw Elon Musk taking over Twitter now, and one statement or one thing he has made clear is no more working from home. That work from home for lifetime, mentality or culture at Twitter out the window. Do you think that other CEOs are going to be looking at this because he's seen as a leader, a mentor to many, and say, yeah, you know what, everyone needs to get back into the office now?
Yeah, I think so, and I think it's also kind of a function of what you just mentioned, that this era of excess liquidity has come to an end. And a lot of these excesses that we saw and perhaps took for granted as a function of that are also coming to an end. So maybe it's just one company, but the fact that he's letting go or has let go of 50% of the workforce sort of begs the obvious question, how many other companies are out there that people could do the same thing and it not affect the customer experience? Because a lot of these companies, have been really enjoying massive success of this excess liquidity that we've had in the economy and zero interest rates. Now that that's really come to bear, some of these incredible projects, things that people could do and afford to do when money was free, no longer the case. So I think we can start to see a big contraction.
Let's talk about commodity super cycles now. Relief rally here a bit in gold and silver as we're speaking. Is this a turning point for the metals, Will? What are you liking? What are you eyeing? Where's your focus? Potentially.
And I think when it comes to gold and obviously to lesser extent silver, I think it's really quite simple for me this year. If you look at the performance of gold in US dollars, because gold is priced in US dollars, if gold is an antidote to the dollar, to fiat currencies, it's performed badly this year because the fiat currency has been so strong in the dollar. But if you look at gold in other currencies around the world, the British pound, the yen, etc., you'll see gold has put in a good performance this year. In some cases, gold has done extremely well. And so when you're in another currency other than the dollar, and the reason to hold gold is to protect against a fall in the fiat currency, gold has done that job. The one currency that's bucked the trend clearly is the US dollar because of the interest rate rises in this economy. And so that has hampered gold. But I think we go back to, is the dollar peaked? And certainly the dollar's been on a downward trend now for the last sort of month or so. If that continues, or indeed it just pauses from here, I think we see the rally in gold, and maybe we've already seen the gold bottom.
And when you say a rally in gold, because I know the folks at home are going to send in emails, well, what kind of rally are we speaking? Is it getting to 2,000? Is it above 2,000?
I don't think it's anywhere near that at this stage. I think for a 2,000 type scenario, we have to see some broader dislocation in the economy. That I think probably the most likely thing at the moment comes from, a mistake from the policy, particularly from the Fed, leading to something major breaking in the economy.
How about the lack of institutional investors and interest in the space? You're on the ETF side. What are you seeing?
Yeah, it's been pretty muted, to be honest, and that's been sort of understandable in a world where interest rates are rising, the dollar's been so strong, and gold has performed badly in relation to that. So it's been a funny year. It's been a year where nothing has really worked except for a lot of the commodity complex.
And I know others would argue, but gold has worked. It has done relatively well compared to other assets, Will.
Yeah, I mean, I guess, yeah, on a
There's
relative
two ways
basis.
to see it, right? Like you could say it's underperformed given the financial landscape we're living in, but comparatively speaking to other assets.
Yeah, so obviously on a absolute basis, people have lost money in gold this year. But on a relative basis, if you're comparing it to the broader market, etc., it's performed, it's relatively well.
Do you think something needs to change? Because I know in the past we blamed Bitcoin. Oh, the money is flowing to Bitcoin, to the cryptocurrencies. But now what can we say? Why is there that lack of interest? I know you say it's understandable, but why is that understandable?
I just think because this is a year where everybody is down almost. So the 60-40 portfolio, which you can say doesn't include gold typically, but this is probably one of the worst years on record going back to the Great Depression. So money managers are really scratching their heads as to what to do. What is it that they can do in this environment that's actually going to work and make money for clients? Equities have not worked, bonds have not worked, and certainly other assets like gold on an absolute basis, people have lost money this year. And I think in that environment, when portfolios are down, it's really tough.
That's a fair point. But let's talk about central bank buying now. 400 metric tons on the quarter of September. What's your take on why some central banks that we hadn't seen buying before are really stepping up? What does this say about their outlook on the world economy?
I think it's more of a question for me, or more of a case of what we've seen from central banks consistently over the last, let's say, 10 to 15 years, which is, we're not talking about sort of Western central banks, so to speak. We're talking about other central banks around the world that are trying to manage currency reserves and create a diversified portfolio largely away from the dollar. And I think in an environment or in a world where the dollar's become so strong and you're importing inflation, having an allocation to gold has become a lot more important for some of these central banks. Let's
just get back to commodities for a second. Interested to get your take on the copper story, the shortages we're seeing there, the premiums that we're seeing placed on copper. Your take on what's seen as the barometer of the economy?
I think, again, it's largely down to what we're seeing in the commodity spectrum or across the commodity complex more broadly, which is these supply concerns or supply constraints that we've had in the market, over the last sort of certainly 15 to 20 months, but exacerbated by years and years of underinvestment. There's just no quick fix for it.
Yeah.
And the bottom line is that a lot of these other variables to bring inflation down, for example, can be brought into line, and some markets are easing. But fundamentally, when you're looking at a metal like copper, that's just so important to affect this energy transition that all the major, certainly Western governments want to enact. And so finding supply of copper and getting supplies of copper is going to be increasing, or is going to be a big challenge over the next decade.
Also interested to get your thoughts on what we're seeing in the crypto landscape. As we're speaking, the FTX debacle is ongoing here. Your thoughts and take on cryptocurrencies, and I guess Bitcoin's in its own separate category, but on the carnage we're seeing.
I mean, it's just, again, I think symptomatic of the ending of this excess liquidity era. And I think we've got to ask ourselves, how many of these things could be possible now? If you were to start cryptocurrencies in this environment where money now has a real price, would it be possible? Could it even survive? Could it exist? And I think you could be talking about, cryptocurrencies as one of these things that could only have happened in this environment of excess liquidity.
Well, that's interesting. If the end of liquidity is here, as you say, then what's the story for Bitcoin?
Well, I think people are already sounding the death knell for cryptocurrencies, already because of not just what's happened with FTX, but if you think about, I think it was 2014 was when Mt. Gox blew up,
right,
which was sort of the first major exchange that was, I think at the time, was the leader in cryptocurrency exchange, or leading cryptocurrency exchange. And 8 years on, have we really learned any lessons? And FTX goes down. It's really probably deserves its own show, because it's an incredible story in terms of how this has happened, and clearly it's not all unfolded as of yet. But I think I sort of go back to this idea that, is this really the end of the crypto industry as we know it?
Do you think it is?
I think that a lot of people now are going to turn away from crypto. I think that Bitcoin, can survive, but I think that once trust has been broken in such an epic way, it's just hard to
Do you think that the
reestablish
banks
it.
are looking at this now and saying, at what point they were all jumping in, kind of this fear of missing out, that they're saying, wait a second now?
Almost certainly. I think that to the extent that banks were involved in the industry,
Yeah.
I think a lot of the major banks looked and invested in things like private blockchains, so using aspects of the technology. But I think in terms of the more speculative angle to it, in terms of trading and lending, I think that will be sidelined, and we may not ever see that.
It's a big statement. It's a big statement.
Well, it's a huge issue that's happened, and people have lost real money,
Yeah.
crazy amounts of money, and again, now that money has a cost, now that you can put your money in the
Right.
fixed income market and earn a real yield, what's the value of something
What
like
happens
crypto?
when people say, and I know blockchain is a separate discussion of itself, but I'm sure you hear the counter argument being in the gold space.
Yeah.
Well, blockchain's here to stay, or there's just too much money behind Bitcoin to fail, that it is the future, that's the only sound money. I mean, what do you make to those counter arguments that I'm sure you get all the time?
It depends on what the specific argument is, but again, a lot of them, I think, are muted by what's happened. And, it's just difficult fundamentally to build a real business on top of an 80-volt asset. And that's, I think, been the real struggle for any kind of enterprise in the crypto world that's not involved directly in either the issuance of coins and trying to get people to trade certain coins, but to provide that, what is the real business that the world needs that can be built on top of crypto.
And I didn't time the demolition with the talk of things blowing up. But Will, I think the bigger point that you're making, and maybe we can just wrap with this note, and perhaps it's too big of a question for this interview, but when you say it's this end of the era of liquidity, right? The question is, have lessons been learned? Have lessons been learned, or will the Fed just repeat? I feel like we're just going to go back into QE.
Well, I think that the odds of that happening are a lot higher than you think, because the Fed ultimately is going to be governed by what's going on in the economy.
Correct.
As I said, US housing is already in recession. 7% mortgages, this is just unaffordable. So financing markets gone, mortgage applications down massively, or major banks. Housing starts have collapsed. You look at the auto market, we saw a reduction on the month-to-month inflation, but again, most people were financing new cars when interest rates were zero. And so the average cost of a vehicle went up because people could afford a bigger and better car while interest rates were so low. But now with auto loans going up to the highest they've been over the last 20 years, again, that becomes very unaffordable. And don't even get me started on credit cards and other things. It just, all these conditions really, really will tighten and change everything.
Good thoughts from you, Will. I guess just final thoughts, bring it home for the folks at home. We're about to really end the year here. So what are you doing? How are you setting yourself up for 2023?
I think in a similar way to what we have, I think commodities is still a bright spot in the market. I think that once interest rates start to normalize, in other words, once we get a better idea of what that peak level is going to be, and I still think we go up close to around 5%, here in the US, I think then we start to normalize, and businesses can adapt, markets can adapt to the new normal or the new reality which is interest rates at that level. And we'll see how long that lasts before, as you said, the Fed's forced to take action because the economy's either in severe recession or it's a lot worse.
We will see, but come back more often, Will. So good to be in person.
Yeah, thank you so much for having me.
Absolutely, and thank you for watching. We'll have much more coming your way on the Daniela Cambone Show, and don't forget to sign up at danielacambone.com to stay on top of all these great interviews. That's it for us. Thank you for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.